Are we in the early stages of a commodity supercycle? This video is brought to you by Interactive Brokers, ranked best online broker by Barron's for the 5th consecutive year. But more about them later in the video.
Well, Jeff, this is probably how these cycles are all alike. But what are the factors you think makes this super cycle different to the last one?
Okay, when we think about the underinvestment component on the supply side, they all had the lack of investment going into the demand boom. What one is going to make this one more complicated is the overlay of environmental policy that makes it very difficult to attract capital into the sector. I like to point out, you look at, oil prices, you look at metals prices, commodities were up, 26% last year, and the year before, 42%. The return in energy equities was 60%. Yet what happened to real CapEx over the course of the last year? It went down. It went down in 2021 as well. So we're not getting that response in investment that you would typically get. I do want to put a caveat here. If you go back to the cycle in the 2000s, the prices moved in 2002. The CapEx didn't come to 2005. People simply did not believe in the sustainability of the story, very similar to what they are right now. It's hard, and I don't know if it's ESG related or if it is people have a bad taste in their mouth of oil and commodities. Let's not forget, energy sector destroyed 54 cents on every dollar invested over the previous decade, and that's entrenched in many investors' minds.
Well, Jeff, some would point out that a super cycle requires 3 indicators: surging demand, surging prices, and surging supply, all in tandem. And they would argue that the commodities markets currently fail all 3 tests. How would you respond to this?
I find surging supply a difficult argument because the 70s was underinvestment across the entire space. The 2000s, underinvestment across the entire space. And today, underinvestment across the entire space. So I don't buy into the surging supply. Let's go to the question about surging demand. Yes, you had surging demand in 1968 with LBJ's Great Society, but throughout the 70s, it started to taper off. By the way, for many of your listeners, I like to remind people, the first attempt at an OPEC oil embargo occurred in 1967. There wasn't enough demand to make it work. It didn't work until 73 after 5 years of LBJ's Great Society. What about the 2000s? It was China's admission to the WTO. What about the current environment? I like to point out COVID was a crisis of inequalities, and it forced governments around the world to focus on the disadvantaged groups. And as a result, we saw stimulus directed at lower income houses, and lower income households consume far more commodities than higher income ones. And as a result, we saw a big surge in demand. And a lot of people will say to me, well, this all disappeared with COVID. No, look at Europe. It's basically levying windfall profit taxes, taking the proceeds from those taxes and giving them as subsidies to lower income groups in terms of energy consumption, keeping the demand picture much stronger. So, people like to say there's not a demand component to this. Yes, there is. And when we think about metals, think about all that EV demand. That's going to be your big CapEx boom. Like what we think about, what was China? China was a metals demand boom to go construct all those cities. This one's going to be a metals demand boom to go construct EVs and decarbonization and green technologies. Very similar to what China was. In fact, we argue that the demand for green CapEx this decade is bigger than the demand for CapEx during the China boom years of the 2000s. And then the decade after that, it's 2 times China. So I really push back against there's not demand for commodities. It's going to be an enormous amount of demand for commodities going forward.
So I've done a heap of videos on my outlook for commodities and commodity super cycle, and I don't want to rehash old information in this video. did this video, don't sell silver, gold and commodities. You might remember I did this video, silver the next lithium, silver squeeze 2.0, talking about the solar panels that have been made in China using double the amount of silver that we first expected. If you haven't watched this video, I'll put all these videos in the description below. I'll put a link in there that you can watch them all if you haven't yet watched them. Silver's clean energy future, just talking about this move to so-called renewables, I call them rebuildables, and what silver's role in that is going to be, and the demand for silver in that move. This video, silver super cycle, similar themes. Once again, as I said, I don't want to rehash all this information. Just go check these videos out. You'll see why I am invested, why I think the way I think. Now, if you don't follow Chris McIntosh, you guys are crazy. Now, if you're a bit of a lefty, you might struggle with him because he doesn't have a filter. He says it how it is, and I like that. You can agree, you can disagree, but I respect people who will say it as it is. And Chris certainly does that. And in this video, the great inflation bull market has just begun. We talked about why Chris in particular is of this view, and I'm actually a client of Chris's, so I follow his work extremely closely. This video, silver, gold, base metals, how to profit from net zero. This is probably one I definitely recommend people watch. It's also the one that I've got in trouble for. So definitely go watch it. If it means I got in trouble, it's probably the one to watch. But really, this is where we're going. This is where the Western world is taking us. You know, this whole push for net zero. It is moving like a freight train. It's going to take a lot of pain from ordinary people, living standards to fall in such a big way before people will rise up to push back against this net zero. And to be honest, I don't think the majority of people will know that their pain is being caused by government's net zero policies. So once again, check this video out. And I've done a video before where Jeff Curry did talk about the commodity super cycle. And so this video is just, I guess, reinforcing our position, our view that we are in the early stages of a commodity super cycle. You have a look at a chart of a commodity super cycle. They don't go up in a straight line. They're not for everybody. If you can't stomach a bit of up and down, if you can't see the macro and see the fundamentals and see the long-term picture, don't even play in this field. Don't even go into this field. But once again, the one reason why, and Jeff mentioned it in that clip about, the capex and the investment into finding the minerals and the metals and the energy that we need for this so-called transition just isn't there. And so there's a massive supply side problems. And I've shown in many, many videos I've done, things like copper and nickel. Where are we going to get it from? There's going to need a huge amount of capex to be able to support what is needed. Now, one of my favorite books of all time, Jim Rogers' Hot Commodities. If you haven't read it, go read it. Go get it on Audible, listen to it, whatever. Just get your hands on it and read it, especially if you want to invest in the commodity sector and you haven't read this, or if you are invested in the commodity sector and you haven't read this, what are you doing? Go and read it. And there's one part in here that just stuck out, just really seared into my brain. And it's why when I look at different markets, and at the moment it's commodities, but it could be a whole different market, in a year or two, whatever. But when I look at markets, I look at things from a fundamental point of view. And in this book, this little paragraph here, which I'm about to show you, really seared into my mind. And I've shared this before, but the very bottom paragraph there, And even when demand dwindles, prices can still climb. How? If the supply falls faster than current demand, the supply and demand imbalances only increase, and so will prices. You can't just turn on the spigot at a copper mine. Ramping up production of an existing mine takes years. So whether it's this whole ESG movement, this whole, mining in general is bad, and we've got a whole generation of people, really, you could argue under 40, but I'll say under 30, that think mining is going to kill us all. It's going to destroy the planet and we'll all die and blah, blah, blah. Like the whole, climate catastrophe movement is just, it's brainwashed a whole heap of kids. So, and they're now moving into, corporate roles. They're now moving into HR in these big companies. And, there's so many investor activists now. I'm thinking about a couple in Australia that run a tech firm that now want to take over every energy firm. And it's okay for them. They can afford whatever. But for the average person, their standard of living is going to crash. Yet I don't think the average person will be able to pinpoint what that is. So because of that, banks don't fund. It's hard to get funding, to get the capital expenditure that's needed to, one, find the metals, then to build the mine, then to actually mine it and go through the whole production cycle. So for mine, supply is going to be a big, big problem. And so what I have done is looked at the minerals, looked at the metals that are going to be needed most. And in those videos that I've done before, in there, I talk about all the different metals. I've done videos why I'm bullish different industrial metals as well as silver. We got to be careful with silver that it doesn't become a fully industrial metal like copper, because then it becomes demonetized and silver is money. So, and I don't want to go down that route right here, but what about interest rates? A lot of people say, well, Steve, you're bearish asset prices because interest rates are rising. That changes valuations. It changes how you value cash flows. It impacts people's borrowing capacity. So surely commodities are going to be hit. Well, what we'll do now is just go back to a clip from that video. But before we do, let's just hear from Interactive Brokers, or not hear from them, hear from me about Interactive Brokers. At Interactive Brokers, you can invest in over 150 markets in 33 currencies while funding your account and trading assets in 26 currencies. And you can scan world markets for undervalued stocks using Interactive Brokers' free online tool, Global Analyst. Interactive Brokers aims to offer the lowest possible commissions and access to US and global stocks, ETFs, options, futures, currencies, bonds, and funds from a single unified platform. Margin rates up to 50% lower than the industry, and wait until I share with you how I use margin accounts to make arbitrage by selling options. You can also earn interest of up to 4.08% US on uninvested cash, and Interactive Brokers' smart routing helps achieve best execution by searching for the best available prices for stock, options, and combination across exchanges and dark pools. Award-winning powerful trading platforms including Global Analysts, Smart Routing, Traders Insights, which is a real-time access to comprehensive research, news and analysis, Global Trader, and their Impact Trading app. Interactive Brokers are listed on the NASDAQ, have over 2 million client accounts, and are well capitalized. They also provide on-demand educational resources for investors and traders of all levels. And as mentioned before, they are a multi-award-winning online broker. So for more information on Interactive Brokers and how you can open an account today, click on the link below in the description. Now, back to the video.
Jeff, could higher for longer interest rates globally suffocate the super cycle before it can really lift off? How big of a downside risk is this, you think?
It is exactly what needs to happen. Think about this. When interest rates are zero, what do investors focus on? long-term growth opportunities, pie in the sky investments, crypto, all of that was what the focus was on, in the in the 2010s or 1990s. What were they focused on? The long-term dot-com boom. Or what were they focused on in the 1960s? Coca-Cola brand growth in these. So the growth, long-term growth prospects are the focus with 0% interest rates. And what higher interest rates are telling you, you bring the focus in near term. You become short duration focused. Another way to say it is higher interest rates make putting a drill bit in the ground more profitable than thinking about long-term tech opportunities. Another way to say it, higher interest rates are telling you you need to make investments in near-term activities. By the way, emissions are up, pretty much. We argue 4.3% last year because people are not focused. They're focused on 2050 emissions, not near-term emissions. And the same thing about as interest rates go up, higher interest rates means you need to make choices. And when you make choices, you have to think about what do we need to do today to debottleneck the system to allow for growth. And so I think that question is another way to think of it is missing the point. Another way to think about this is higher interest rates make that long-term tech story not very interesting, but they make the near-term oil, metals, agriculture, and these old economy boring assets far more interesting in a higher rate environment. And let's think about what happened in the 1970s, higher rates and more investment. What happened in the 2000s, higher rates, more investment. And you can think about higher rates mean a better return in the physical world than in the financial world. And that's the world we're heading into.
So there you have it. Interest rates, higher interest rates likely to be good for the commodity sector. And yes, I am bearish risk on assets for all those reasons I mentioned, borrowing capacity, the way cash flows are measured, and here we've got a chart. So US stock market has suffered significant contractions during inflationary periods. So here we've got the 1910s, 1940s and 1970s. So the CAPE ratio declined, as you can see there, over 47% on average in the 1910s, 40s and 70s. So still today's valuations are too high for how elevated cost of capital is with no real growth. And this is coming from Tavi Costa from Crescat Capital. What's the PE on the S&P? It's still almost 20%. So for mine, we've probably had the 1973 part. Now comes the 1974. I always talk about this, 1973, 74, where asset prices fall or the stock market falls almost 50%, while CPI remained elevated. I think it peaked in that period. It peaked at about 12.5%. And so, yes, I believe we're in an inflationary decade ahead. But once again, nothing goes up in a straight line. It goes up and down, up and down. But Lynn Auden just did a awesome thread today about will prices come down to pre-cerveza sickness or whatever you want to call it levels. No, it's not. It always remains elevated. And so in my opinion, interest rates are going to have to remain higher for longer, and that's going to put downward pressure on asset prices. When you measure cash flows, when you look at borrowing capacity, that's downward pressure on prices. Changes people's attitudes around growth, and definitely fast tracks things into value. And right now, what's in my opinion the most undervalued asset class is still commodities, even though they've done quite well in the last few years, especially energy like coal and oil, gas, etc. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. Do you think we're still in the early stages of a commodity super cycle? I know there's a lot of people out there bagging that idea. A lot of people also don't have the patience. Once again, I've shared charts before. These are long-term super cycles and they can have 50% retracements within that super cycle. So a lot of people get shaken out because they don't see it, they don't believe it. I do, for all the macro and fundamental reasons. I see it. Jeff Curry has listed some arguments why he sees it. What do you guys think? Anyway, guys, if you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you all again on another episode of Finance Uncut. And just a reminder, the information provided in this video is for education and entertainment purposes only. Nothing on this channel constitutes as financial advice. The information in this presentation is no substitute for financial advice, and all investors should seek advice from a licensed financial advisor having regard to your own objectives, financial situation, and needs.